Good afternoon. This is Sean Golding with Golding and Golding, here to discuss an issue that comes up a lot, especially with our clients from Australia. It's not only the superannuation, but kind of understanding how to look at the superannuation when looking at the U.S. tax treaty. There's not one particular way to read a tax treaty, depending on what you need it for, what you're using it for, and what you want the outcome to be, so to speak. There are different ways to evaluate it. Let's take a look specifically at how superannuations are impacted by the tax treaty. First things first, superannuation, it's a type of pension slash retirement slash kind of hybrid social security in Australia. A lot of U.S. citizens who are also Australian citizens or residents in Australia, worked in Australia, may have a superannuation, depending on whether they're contributing or not, where they reside, if they're receiving distributions and whatnot, will impact how to treat the superannuation for tax purposes. The most important issue, I guess, from part one is that there is no mention of the superannuation in the treaty. Treaty first came out in 82, 83, superannuation a bit after that, so it doesn't account for the superannuation. Superannuation has become a big deal when it comes to pension and retirement. So when you're looking at the different articles of a tax treaty, looking at Australia specifically, let's start with general pension, Article 18. Article 18 has 6 different subsections to it, and the general rule would be, looking at paragraph 1, you would think if you are residing in a country and you are receiving pension for work that was previously performed, something like a super, then you can only be taxed in that country. So if you're in Australia, the tax to the super generally goes when the contributions are made, or the growth actually within the super, depending if it's concessional or non-concessional. But payouts are not taxable, right? So you're a U.S. citizen, you're living in Australia, you're enjoying your life there, you're getting your retirement, and you're not being taxed. Now, for public pension, university, government, that's not going to be taxed generally anyway. Because Article 19 says that it's limited to the country of source. Australia would be the country of source for a superannuation, not country of residence, and they're not going to tax it. So you're not going to get taxed by the U.S. on that, let's say. But now when you're going back to paragraph 1 of Article 18, you're thinking, great, well, I'm not going to get taxed on this either because I live in Australia. Then you have to move on to the saving clause, right? And the saving clause basically says, despite this incredibly dirt tax treaty that was created between the U.S. and Australia, it doesn't matter, because each one of the countries, the contracting states they call it, reserves the right to tax you as they otherwise would tax you. Now, the U.S. is one of those ridiculous countries that taxes you on your worldwide income based on citizenship-based taxation, citizen-based taxation. You don't have to be a citizen, U.S. citizen, lawful permanent resident, foreign national who meets the substantial presence test, certain expatriates, tax you on your worldwide income. So the mere fact that you're residing in Australia doesn't mean you get to rely on Article 18, paragraph 1 of the treaty. Instead, the saving clause is going to go ahead and say, well, we can still tax you on that. Then you go below that, right? I think it's Article 1 is the saving clause, right? And then paragraph 4, which basically says there are some exceptions to the saving clause, right? So working back, you've got the treaty that has all this great stuff about taxes. You've got the saving clause that says, hey, hold on, each country reserves the right to tax you how they want, or how they ordinarily would. Then you have exceptions to the saving clause. And those exceptions basically say, hey, we don't care about the saving clause. Whatever is written in the treaty is essentially what's going to hold for purposes of tax. Now, what you will find is, while there are a good amount of exceptions, some of them involving Article 18 as well, Article 18 paragraph 1 is not included in there, right? So that would not protect a U.S. person who is residing overseas and receiving income from a superannuation. Now, if you're a permanent resident, other type of resident, you may be able to claim that you should be treated as a foreign person under the treaty. And so therefore, if you're treated as a foreign person, then you don't get taxed as a U.S. person. The pause there for a minute was just that you have to be very cautious. I always like to remind people of this, that if you are a lawful permanent resident and you are categorized as a long-term lawful permanent resident by making an election under the treaty to be treated as a foreign person, well, that's sort of a tripwire, and now you've expatriated. That's the expatriating act. You actually don't have to go down to the consulate. By doing that, you may get yourself into a sticky situation. So these are things to consider about the Australian superannuation under the treaty. Different firms may have different positions on how to treat it, privatize Social Security, things of that nature. This is how we do it here. Again, my name is Sean Golding with Golding & Golding. Thank you for your time. Enjoy the rest of your day.